necessarily do anything, but I'll give you a quick update because so far you don't have to have pliers in the back of your car because the deal with my dentist and orthodontist is still a work in process. So we're still on, at least for now, we're on decent terms. So hopefully if things come into pass come the fall, for some of you, when I'm teaching partnership tax, I will not have braces, so that will be a good thing. Any event, let's bring ourselves up where we are to date. Just to remind people what we've covered and what we're covering today. And I say this, it's hard to believe, things go quickly. Our last class is on Wednesday, what we're going to be covering on Wednesday. So as we quickly look backward before we start the new material today, I'll just quickly grab the index. We have our general introduction, chapter 1, taxation of corporations. And again, if you want a confidence builder, I hope at least, if you go back and you read some of the material in chapter 1, it should be a lot easier to read. One part in particular, chapter 1 deals with, 1B deals with the corporation as a separate entity. And it talks about the pros and cons of being a corporation versus another kind of entity, in particular an S corporation. Keep in mind, all the rules you've learned in this class are largely apropos to S corporations. So you get 2 for the price of 1. If you know how a C corporation is taxed, you largely know how an S corporation is taxed with several caveats to that, but much of the information is the same. Chapter 2 deals with formation issues, but as I warned you, even though that's at the beginning of our unit or beginning of the course, 351 issues pop up all the time, anytime, even immediately before liquidation. Chapter 3 deals with corporate structure, trying to distinguish between debt and equity issues. And the latter part of that chapter deals with the sale or disposition of equity versus debt. What are the consequences associated with each? Chapter 4 is a big one. Chapter 4, when I say big one, its themes keep repeating in later chapters. Non-liquidating distributions. Just because you guys are now clued into this, notice it's not called non-liquidating dividends or a chapter. Many undergraduate courses entitle the chapter dividends, okay? But you guys are more sophisticated. We need to know what the earnings and profits are of that entity. And we always evaluate, right, the shareholder level, just like we did in chapter 2. You looked at the shareholder and you had, for example, 358. You looked at the corporation, 362. Similarly, when we're dealing with chapter 4, non-liquidating distributions, we look at the effect to the shareholder, say under Code Section 301C1, 2, and 3. We look at the effect of the corporation. The 2 big ones, Fanta, are what? The effect at the corporate level for Chapter 4, non-liquidating distribution. You're whispering. But 1032 really applies upon formation issues. Here a corporation is making non-liquidating distributions. So what code sections quickly get triggered in your mind, Carolina? 311 and 312, right? You could just pull out your outline for that chapter, right, Fanta, and you'll see your little structure, right? That outline that you guys are all preparing, that for each chapter with a little schematic of what code sections apply where. So, Fanta, you just have to keep in mind, code sections 311 and 312 are the big ones in that kind of context, all right? And 312, remember, cuts only one way for the government's favor. Gains are recognized, losses are disallowed. We're going to see when we talk next class about liquidating distributions, that is not necessarily true. Code section 336 at the corporate level, we'll see, will play some games with you because now losses may be allowed. Okay, for the first time, you may see losses which are allowed. All right, so chapter 4, we looked at all sorts of distributions from a corporate entity. And we also saw at the end of that chapter anti-avoidance mechanisms. Why anti-avoidance? Because we know what kind of shareholders in IRMA want dividend treatment. Corporate. Why? What code section? No. No, got to talk the talk, not dividend discount. What is it called? Dividends received deduction, right, Irma? Okay. Dividends received deduction in what code section, Mabo? 243, right? And it's 3 tiers, 70%, 80%, or 100%, right? Right? So remember, philosophies differ versus if there's a square versus a circle over another square, right? So know your shareholder, right? Know your shareholder. Okay. Then, chapter 5, dealing with redemptions. Our key code section on this one. Gary, what code section deals with redemption? Well, let's start with 302, okay? Let's start with 302. What does 302 say? What is the general rule? What does it say? How do you get to the world of redemptions? Gary? Say again, Greg? What I'm saying is, how do we get to redemption? What is the gatekeeper? 302, but 302B. And Gary, which one is the first one you go to in 302 to see if you cross the line? 302, Jerry, you were going to say? What? Well, B1 is not really where you want to go the first shot, right, Jared? B2, right? Because you want to try to apply the mechanical test. It's going to give you a lot more full nights at your ambient than B1, right? If you can't meet the B2 test, Gian, what test might you go for? Okay, but that's the 302B2, but if you can't meet that test, you might go to B3, right? And B3 typically necessitates what, Paul? Well, it is a termination, but what code section do you often have to rely on? 302C2, right? We have to waive family attribution rules often, not always, right? Because we know under 302, right, Angie, we have to apply code section 318, right? And all these attribution rules come into play, and it's very hard to terminate if it's a closely held family business. So 302C helps us along that path. If we can't meet 302 B3, we may have to rely on B1, which is a lot more murky. Go ahead.
So if you do not meet 50%, that's right then and there. You don't have to do 88% test.
You're done. I mean, remember, 302B2 is a conjunction test. I don't think if you don't fall below 50%, I'm not quite sure if you're going to ever meet the B1 test either. So I don't think you're going to have a real redemption in that context. Brian, if with respect to, we looked at the individual level, but at the corporate level, Brian, what might give us a redemption? Which is what? Brian, what is it? Partial liquidation defined where? 302B4. E2. 302 E2, right? Okay. 302E in general, but 302E2 offers a determination of business. And does that extend, Andrew, to all shareholders? And which does it not? Okay, does not extend to corporate shareholders. And Ryan, if you do have a corporate shareholder, what code section does apply? Say again, Ryan? Priscilla? Am I getting to 311? Eeyore? 1059, right? It's going to be an extraordinary dividend to that corporate shareholder. So you can anticipate a basis reduction of that corporate shareholder's interest in that entity. Okay, so we go through, or the authors have been kind to us, they go through this pretty systematically, looking at B1, they start with B2, then they go to B3, then to B1, and then we look at B4. The next part of the chapter, Fanta discusses code section, the implications under 311 and 312. And generally, in this case, what do we have, Topeka, in terms of what happens to the earnings and profits if there's a redemption of a corporate entity? Not sure? Lee? That's true, 311. But what happens to the corporation's earnings and profits? Fatima, say again? Does it go? Yeah, but does it go down, Matt, by the amount of the redemption? By what? Proportionate share, right? Everyone agree? 312N7. Fatima, you got to have that in your notes. It doesn't go by the amount that's being redeemed. It goes down pro rata. So if there's a 17% redemption, the earnings and profits will go down by 17%. Right? So everyone have that? 312N7 when there's a redemption. We talked, the authors briefly talked about Code Section 162K, about redemption expenses being non-deductible. And then they talked about redemption planning techniques. And we said that this often comes up in the buy-sell context, right? You have cross-purchase agreement or redemption agreements. We talked about in the divorce context, charitable giving. And that's essentially where we left off. What we're covering today, we're going to finish Chapter 5 and talk about redemptions through related companies and redemptions to pay. It's kind of funny, at least in my mind, I never really paid attention. The heading is redemption to pay death taxes. It sounds like the Republican Party, is a big fan of repealing the so-called estate taxes or death taxes. So I never referred to it in the textbook as death taxes, but so be it. And then we're going to talk about Chapter 6 dealing with stock dividends. Okay? The final class on Wednesday, guys, we're going to talk about, and I'm just looking at the index in Roman numeral 13. If you check out Chapter 7, which I hope to get to towards the very end of today, talks about complete liquidations of normal liquidation, what I'll call a generic liquidation. And you'll see there's the whole second part of that chapter is devoted to liquidations of a subsidiary. And the consequences are going to be vastly different. So for exam purposes, one of the first things you're going to have to, if there's questions, and there will be, I don't mean this in a bad way, there will be questions on liquidations, make sure you distinguish, is it a liquidation of just a corporate entity or is it a liquidation of a subsidiary? Because obviously your analysis is going to be vastly different depending on which it is. Okay, that's sort of brings us up to date. Any questions? Logistic or otherwise? Okay. All right, so let's pick up where we left off. on page 274. Right, everyone agree? Page 274? And we've already agreed in this course and other courses that any time you have a transaction with a related party, your antenna goes up and sweat forms at your brow because you're fearful that you're missing something, and that's not a bad position to be in, to at least recognize that danger lurks. And what we said towards the end of last class, and this stuff is not easy. It's particularly not easy on a Wednesday night after being here for 3.5 hours or 3 hours or 45 minutes. So I'm not so sure what stayed or what didn't. But we spoke about the fact that if we have a shareholder and this shareholder owns two entities, and X and Y, and some of the X shares are sold to company Y, that is this the issuing or the acquiring company? Do you recall? Which one is the issuing? Hannah, which one is the issuing and which is the acquiring? Well, if some shares are now owned, this becomes the issuing and this is the acquiring. Okay? And that's going to be important because when you look at Code Section 304, we're going to have the benchmark for whether or not there was a meaningful change in ownership is to look at the before and after effect of the issuing company. So Code Section 304, just to keep our code section open, 304 talks about treatment of certain stock purchases. And it relies on things that we looked at in Code Section 302. We haven't looked at 303. And it says when in Code Section 304A, when one or more persons are in control of two corporations. What is control? Control is defined under Code Section 304C. Code Section 304C. For purposes of this section, control means the ownership of stock possessing at least 50% of the total combined voting power of all classes entitled to vote. So if you have more than 50%, at least 50% or more, you're in control of both entities. And unless paragraph 2 applies, which we'll get into in a moment, if you read Code Section 304, it goes on to say, to the extent that such distribution is treated as a distribution to which Code Section 301 applies, 301 is our distribution to a shareholder, the transferor and the acquiring corporation shall be treated in the same manner as if the transferor had transferred the stock so acquired to the acquiring corporation and exchanged the stock of the acquiring corporation in the transaction to which Code Section 351A applies. In other words, guys, what we'll see is when we apply Code Section 304 and when we look at the before and after of the issuing company and it doesn't meet any of the requirements under 302, B1, 2, or 3, essentially we're going to treat this as if the shareholder made a 351 contribution down to Y Corporation. If the person made a 351 contribution down to Y, what code sections apply? Code Section 358 at the shareholder level, Code Section 362 at the corporate level. Now, there's a lot of code sections flying, and we'll see an example of this, but the point is, if this is not treated where there's a meaningful change, and where's my authority for meaningful change of the issuing corporation? Look at Code Section 304B1, rules for determining under 302B, right? 302B is a redemption section. 302B, 1, 2, and 3. It's not going to be under B4, right? We're not talking about partial liquidation, so it's got to fit within the scope of B1, 2, or 3. It says, in the case of any acquisition of stock to which subsection A of this section applies, determinations as to whether the acquisition is, by reason of 302B, to be treated as a distribution in part full payment in exchange for the stock shall be made by reference of the stock of the issuing corporation. See, I underlined in red the word issuing corporation, at least in my code, to remind you that, again, what's important here is to keep our eyes focused on the issuing corporation. If we determine that 302B1, 2, or 3 does not apply, then we're going to treat it as a normal 351 transaction, and as if there was a distribution made by the acquiring corporation, and that's why the earnings and profits, Fatima, you'll appreciate this, that if you look at B2 there, we got to figure out which amount constitutes dividend. Usually we only have one company, right? We look at the E&P, the current E&P, and the accumulated E&P of one company, but now we get to look at the earnings and profits of both the acquiring corporation first, to its earnings and profits, and if it's inadequate, then we get to use the earnings and profits of the issuing corporation. All right. And one of the hardest things about Code Section 304 is its application, obviously, but just spotting it. I'm telling you, this does not come up often in practice, and one of the hardest things about things that don't come up often in practice is those are the things that are most dangerous. Those things that are hard and they come up regularly in your practice, you're sort of used to them and your brain goes there. 304 is one of those things that every 2 to 5 years might come up, but if you don't recognize it, it can be very dangerous because people say, oh, it seems so, well, when we go through the case, you'll see where danger lurks. Let me just call attention on page 276. The authors talk about collateral tax consequences in the italicized language. And what I wrote here, at least in my margins, in red, the discussion on page 276 discusses first a brother-sister entity. What are the consequences of a brother-sister in contrast to if you have a shareholder and there's a parent subsidiary? The first part of this discussion deals with what are the consequences in the context of this situation. And that first paragraph on 276 that extends to page 277, I have in my margin, what happens, that first paragraph discusses if it's just a plain vanilla 301. In other words, that 302, B1, B2, or B3 did not apply. So we just have a 301 kind of transaction. And it says, in the basic 304A1 brother-sister example above, where the amount paid by Y for A's X stock is treated as a 301 distribution, A is deemed to have transferred X stock to Y in exchange for Y stock in a hypothetical 351. Y is treated as redeemed its Y stock it hypothetically issued in that exchange. Y thus takes a transfer basis from A in the X stock under 362, and A's basis in Y stock received in the 351 is equal to A's basis in the stock A actually received when it transferred to X. When we go through our first example, you'll see how this applies. There's a lot of code sections, but it's really not challenging when you actually apply it. On the second I'll call it the first paragraph on page 277, talks about, in the brother-sister context, what actually happens if there's a true exchange. If the ownership in the issuing company satisfies the requirements of B1, B2, and B3, one of the three, doesn't have to satisfy all, just satisfies one, and then it's treated as an exchange, the normal exchange rules apply. On page 277, explains the normal exchange rules. The next paragraph, the second full paragraph on 277, I have written in my margins, the effect on earnings and profits is unclear. If you do have an exchange treatment, it's not clear what effect there will be, if any, on earnings and profits. So that's left open. That's been the case in the last 4 editions of this book. It's still not clear what the effects on earnings and profits. The last incomplete paragraph talks about the apparent subsidiary kind of arrangement and talks about the consequences in the context of a parent subsidiary and what happens if there is what I'll call a distribution under 301 versus if there's an exchange. So it parallels the earlier discussion on pages 276 and page 277. Now, on a Saturday morning at 8:30, this stuff is not going to be crystal clear. But give me a few minutes, and when we go through the examples, I think you'll see how this plays out, and it's not as complicated as it looks. Let's turn to page 279, and let's consider this case, and at least without going through the numbers, see when you can have something like this come up. Okay? So if you read this case, and I have, again, not the prettiest, but something for me to work with. We have a husband and wife, Bernard and Tessie. They own shares of an entity. And it's not AT&T as in the phone company, but a closely held business. And they have 2 children in the business, in this business. So these are their children, and it's Bernard and Walter. And apparently, the husband and wife here had 5 children, right? And there's another company, Lentz. And this is owned by 3 children. There are other 3 children. Ed, Linus, and Thomas. Everyone agree? It's not the Brady Bunch. So that's your graphic, I think. What happens next now that we put this out here? There's a dispute. Who said that? Okay. Tell us more about the dispute. One. Say again? There's 2 B's. Right. What does that mean? I mean, the parents, what percentage do the parents own of AT&T? They actually own 22, but through attribution, how much do they own? 90 some odd percent. And what percentage do they own of Lentz? Through what? Through attribution. What code section are we thinking about? 318, right? Everyone agree? Through the family attribution rules, which we have to apply here, and what? Just keep in mind, you just don't do it because you feel like doing it. 304 C3 says to apply. Says to apply code section 318. Okay, so Atik, we got to apply the family attribution, and the parents own a lot. The vast majority of this company and this company, right? And there's a dispute between siblings. I know most of you are sitting there, never could happen. Yeah, it can happen. It never gets that bad, right? But now it's really bad, right? And what happens? Okay, so these companies aren't getting along, so to speak. So what do the parents do to try to resolve this or help this? You stop there, Christy? You're going to...
It's all their shares in AT&T to let all of their common shares.
Okay, so they're going to sell their common shares of AT&T, right? So whatever percent they own now lends to them. And what are they trying to do? I'm not quite sure how this is going to work, but forgetting about the corporate governance issues, what is their goal?
What is
The parents' goal.
they wanted to recommend capital gain on that.
They did, and apparently they also want to help their sons out. All right, I'm not sure how this was going to help them because somehow it was going to give these guys a voice in this company. But again, don't ask. But at the end of the day, let's just talk tax because I don't know from a corporate governance perspective what their real goal is going to be here. But they want to help their sons out here in some form or fashion. But so they're not going to have any direct ownership, right? Do you want to correct me in my mistake when I just said that?
Well, they still have preferred stock.
Okay, so they sell all their common stock, but they have this is supposed to be a thin string attached in the form of preferred stock. But they sell their common stock, and they're thinking, their tax advisor is thinking like any other tax expert, gee, we'll have Code Section 1001. What kind of asset is corporate stock? Capital asset, Code Section 1221. And they're also thinking, because their tax advisors are great superstars, they're also thinking, right, Jean, that 1244, if there was a loss, they could command possibly an ordinary loss if it was a closely held business. But it doesn't matter for our day today. They're thinking capital gain. They're thinking amount realized less adjusted basis, and they're going to report their capital gain. And I guarantee 95% of tax return preparers, 95? I'm wrong. 99% of tax preparers would say, that's right, right? They know. They would report that on a Schedule D. Everyone agree? All right. But it's not going to be a good day in Mudville, right? Because what happens in this context? Because before and after Christie, what are they? Which is the issuing company and which is the acquiring company, guys? Okay, this is the issuing company, right? And I know it seems evident, guys, of course that's the issuing, but I would, were I you, in all my things, I always label it because it's easy to miss that. And then what becomes our measuring rod? Issuing, right? The code instructs to look at before and after at the issuing company, right? And before and after, Christy, what did they own before and after? Yeah, they own, like, just keeping it simple, they went from, this is on page 282, 90.49% down to 82.96. Is that a meaningful difference? No, everyone agree. If you go down from 90% to 82%, not going to get you to the promised land, right? All right, so bearing that in mind, okay, so they first say, by the way, look, 318 shouldn't apply here, right? Everyone agree? That's at least the first tactic, that we shouldn't have family attribution because there's bad blood. And the court is not too receptive. Well, that's not right. Not at all receptive to that. Why is that, Christy? Well, factually, what did they say about bad blood here? But they even go further, Carolina.
Well, they cite this entire case, but then they say that it's no longer applicable. So they say that it wouldn't even apply.
I think there's one fact that,
There was also no evidence as well.
well, the siblings may have hated each other, but there's no evidence that the parents didn't get along with the kids. Okay, so it's one thing to say there's family hostility and we're going to cut off attribution because we don't get along with the other side. But here they got along with the other side, at least. So the court probably wouldn't have been receptive anyway, but they're saying, hey, there's really no bad blood or nothing that was called to their attention between the parents and this side, right? So it was the brothers that weren't getting along. So 318 does apply. Now that we have 318 applies, what, guys? We have to, right, JP, we have to apply, Akash, we have to apply what test here to see if we can possibly get this into redemption territory? What? 302 what? B, not 1, not 2, but B3, right? Everyone agree? Everyone agree that the only way the parents are going to work here is if they've been terminated. Now, just like what we were saying before, they don't own any stock in their name. Everyone agree? They don't own one share in their name. Agreed? So they've been terminated technically as a shareholder. They don't own, I have to correct myself, they don't own any common stock in their name. Agreed? Okay. So they could possibly file the C2 waiver, right? Mercy, do you recall, Cassandra, do you recall, did they file it on time? Did they file this waiver? But they didn't. But there must have been a moment of panic because they subsequently did file it, where someone must have, I'm not quite sure if they were being audited. I can't imagine that someone woke up in the middle of the night and say, did we ever file that C2 waiver? I just don't have that visual. But it did get filed, and the court is, how do we say, it's receptive. You know, it's not clear if a if it should be acceptable, but the court's not going to punish them for their late filing. Okay, that's not going to torpedo their effort here. All right, so everyone agree that they want to negate attribution. You know, they want to set up the blockades and try to limit family attribution up to them. And if you recall from our discussion from 2 classes ago, you have to meet certain requirements. You can't hold an interest in the company anymore. You can't work there. All those requirements. So, Christy, they're desperate, right? Because what happened? You know, they were reporting capital gain. Everyone agree? But what happens if they don't meet the B3 test? Where are they going to be left? They're going to be under 301 under what? Because this is going to be under Code Section 304. Now, you might say, gee, it doesn't look like this, right? Everyone agree? It's not, you know, you came at the end of last class and now at the beginning of this class you have a nice schematic where someone owns 2 companies and they sell one interest to another and say, you know, that doesn't pass the smell test. It looks like this person is nefariously trying to extract earnings and profits out as capital gains, right? Everyone agree? So it looks very nefarious, if you can put that kind of adjective to it. So this person looks, you know, evil of some sort. But these innocent parents doesn't look anything like that, right? Everyone agree that it has a lot different look to it, and that's what gets dangerous because you're doing your analysis or your client is, and they don't see this, they see this, and they say, why does Code Section 304 apply? Agreed? And you see 304 apply because the truth is that the parents really do, you know, really own this, but you can't, it's not on, you know, not there visually. So it can be really, do you see how I can, you can, we can all, and our brethren tax plan preparers can all get into trouble under Code Section 304? If you don't see the trouble you can get into, then you're really in deeper trouble than I would imagine. I mean, I can see this. Hopefully you can. That this is tough to see. It truly is. So the parents have no nefarious motive per se. They're trying to do the right thing, whatever they perceive ethically between and among their children. They're not really doing this for tax motivated reasons, right? But we all know tax motivation doesn't necessarily mean anything, at least in this context. So they're engaging in this sale, the issuing company to the acquiring company, and if they can't meet the B1, B2, or B3 test, then it's going to be considered as if they contributed their stock in lengths, okay, to this company, and they're going to be treated as they're going to get, to the extent of the earnings and profits of this company, whatever monies they were paid, to the extent of earnings and profits of this company, it's going to be treated as ordinary income, and then to the extent of the earnings and profits of this company, it's going to be treated as ordinary income. And when we go through the problem set, we'll see how you got to look at the stock of both companies, the earnings and profits of both companies. So, having said that, could they waive family attribution? Because now they're desperate, okay? You would be too if you're their tax planner and you put your name to this. Like any other people who are desperate, you're going to try to make whatever arguments you can make, and they're going to make four arguments on the bottom of page 283 to try to get them out of this quagmire. And Christy, did any of these arguments prove compelling to the court? Which you want to go through each one very quickly?
They argued that the preferred stock that they still owned in AT&T was actually dead.
Okay, let's slow down. Preferred stock, they say, is dead. Okay, what is preferred stock? They say, look, when you look at preferred stock, it's really dead. And the court says, come on, essentially says, come on, this is not dead. This dead is dead, and preferred stock is not dead. You can't say the two are synonymous. This is spelled out on page 284. Next, they argue.
De minimis.
They say there should be a de minimis rule, right? Because we didn't own much. We owned just a very, very tiny fraction of what we owned before. So you should read in the de minimis rule. And the court doesn't accept that invitation that it should unilaterally, that's what we would call an activist court, right? You don't have to be conservative or liberal. If the court took it on its own initiative to say, oh, gee, let's put in a de minimis rule, then people would accuse the court of being an activist court. Court's not going to bite at that invitation. Next.
They argued that the donation of the preferred stock in December was immediately after the sale of common stock reduction.
Right. I mean, they're saying, if you look at the phraseology, even though it took several months for them to get rid of their preferred stock, what's a few months between and among friends, right? That should mean immediately after. It reminds me shouldn't, but it does. The Scopes Monkey trial where you say, the earth was created in 7 days. What's 7 days? Well, similarly, that's their approach towards immediately after. The court's not going to buy into that. Done. Lose on that issue. And finally?
That they had intended the entire time to donate the stock to charity.
Yeah, they're charitably minded. They just never put it on paper. But, of course, they had always intended from the get-go to make this donation. And it was all part of a plan. And on that basis, they should be considered as if they could waive their family attribution. And the court says no. So later that day, the tax practitioner who put this all together probably contacted their malpractice carrier because these people could have, with good planning, easily avoided this, right? This is not something that couldn't have been avoided. The hardest thing was spotting it, okay? The hardest thing was recognizing that there was a 304 issue here, which is not at the tip of most practitioners' tongues, right? And it may not be at yours. Your your senses may be sharpened a month or year or years from now. But again, the only thing I can help you with is anytime you have a transaction with related parties, just be forewarned, you may not remember the specifics of Code Section 304, but before you come up with a tax favorable result to your client, always think, is there some sort of landmine there? Often there is, not always. And this could have been avoided, right? Very easily. They could have, sold the preferred shares. They could have donated the preferred shares before. They should have, or memorialized that they were going to truly donate them. I mean, there's 100 different ways they could have been successful. All they had to do, they or their tax practitioner, was recognize that there was a problem, and this could have been put to bed. All right? Any questions on this case?
I want to go back to the 304 like for the taxpayer, basically, it's going to be capital gain.
No. Under 304, it would be ordinary income to the extent. Yeah. And we're going to go through examples, numeric examples, soon. So this case is just issue spot. It's not to go through the numbers. But keep in mind, whatever they sold it for would be ordinary income to the extent of the earnings and profits first of this company and the earnings and profits of this company. Then they would have a return to basis, 302C2, and a capital gain on whatever remained. Shahid, you had a question?
Yes, even if they had donated before the common stock and
No. They could have then waived family attribution. That would have been okay. If they got rid of the preferred, they would have, and then they could cut off family attribution under 302C2. They would go from 90 down to 0, right? They would be under B3. And then they could get the treatment they sought, which was a 1001 capital gain. And then this corporation would have had a tax basis in the purchased AT&T shares equal to what? Say again? I can't. Which is Code Section 1001, 1012, cost basis, right? They would have had a cost basis. If this was truly an exchange, when a company buys shares in another company, what basis does it take in that newly purchased shares? Cost basis, right? Code Section 1012. In this context, and Irma, we'll get to the numbers right now, is what happens here where it's not treated as an exchange, this company will take a basis to whatever the parents had in the shares. It will just be a Code Section 358. It would be a carryover basis. Excuse me, I'm saying that wrong. I apologize. It will be a carryover basis, but under Code Section 362. You were supposed to correct me. I was just testing you on that. Okay? 362. The corporation will have a carryover basis. The parents will have a basis in their lend stock. How do I say this? Now, they sold it. Their children, since they don't own lend stock, will take over their basis. It will be as if they, under the examples and the regulations, as if it would swing over. At least not under the proposed, but the existing regulation. But look, let's go through the problem on page 286. Now, the first problem on page 286 is what we just did. It says, this is a good example of tax planning blunder. It illustrates the need for sensitivity to the provisions of Code Section 304. Make sure you can answer the following questions. Why did 304 apply to the sale? They're AT&T. We know why. Given that 304 applies, how do we test redemption to determine that the taxpayers have dividend, and we test it with respect to the issuing company, right? Why were the taxpayers unable to waive family attribution, qualify? Well, they had a tainted interest, right? Their maintenance of their preferred stock violates their ability to make that election, right? Everyone agree? You can't have any interest aside from a creditor. How could they have avoided this? We got them rid of their preferred stock. Okay, question 2. We have Bale Corporation and Out Corporation. Each have 100 shares of common stock outstanding. Claude owns 80 shares of Bale stock with a basis of $40,000 or $500 per share, and 60 shares of Out stock with a basis of $9,000 or $150 per share. The remaining Bale and Out are owned by one individual who's not related to Claude, and Bale has no current earnings and profits. Out has no current and $5,000 of accumulated earnings and profits. Determine the tax consequences of the following. All right. Once again, guys, absent doing a picture, I'm not quite sure how you could follow this. There's Claude at the top. He owns interesting 2 companies, and we're told that he owns 80 shares and told $500 per share, and his total basis is $40,000, right? And here Claude owns, and this is called Bale. Gotta love the names here. Out. And here Claude owns 60% or $150 per share for a total basis of $9,000. So other people own the balance. These other people own 20. There's a total of 100 shares outstanding. Apparently, the other people here own 40, right? We're told here that the accumulated earnings and profits equals 0, current earnings and profits equals 0, and the accumulated earnings and profits equal 5, current earnings and profits equal 0. Everyone have this? Any questions? Good? All right. Now, Claude sells 20 of his Out shares, in which he had a $3,000 adjusted basis, to Bale for $4,000. Okay? So, right? He's not going to own 60 anymore. He's only going to own 40. And now Bale's going to own 20 of Out. Agreed? And we want to know the tax consequences. Now, does Code Section 304 apply here, Adele? You're not sure? Abu? Does it apply? Is it a yes or no? Abu? Not sure? Shahid? Okay. Alice? Does it apply? Does 304 apply? Sharon agree? Disagree? Kevin? What do you look for to see if 304 applies? Control, right? Reminds you, reminiscing down memory lane. Mercy, what code section, when you hear the word control, do you typically think of? What code section? Say again, John, Scott? 368C in the context of a 351, right? Everyone agree? And in that context, what is the control? 80%, right? Everyone agree? We didn't have control for 351 purposes unless we met 368C, the 80% test. But now we're in a different world, right? Speaking of different worlds, I did read the reviews to World War Z, and at least I think they were pretty good, at least in the New York Times. You saw it? Who saw it? All right, you owe us a review, Jared. I'll circulate it. All right, different worlds, okay? So we're in a different world. Code section 304 has its own definition of control, right? 304C, right? And this control threshold is much lower, right, Kevin? It's only 50%. And that, right, Alice, Sharon, suggests why 304 does apply here, because we have Claude, master of the universe, controlling two companies. Agreed? So our antenna goes up because anytime you're in control, special rules can apply, and they might apply here, 304C. He's selling one company that he controls to another company that he controls, right? He controls 80%, 60%, right? Everyone agree? And again, it may not be as obvious as this, right? That's the problem that happened in this case. It was not as obvious. Now, with the pressure on, in this case, what do you say, Chloe? Which is the issuing? What's the acquiring company here between bail and out? You have a 50-50 shot. Chloe? Bail is the issuing and out is the acquiring? Bail is getting the out stock. Say it louder. Okay, and which one are we going to measure the before and after, Chloe? Right, we're going to measure the issuing company before and after. Everyone agree? What's my authority for that? That's spelled out in 304B, B1. Okay? All right. Say again? Why is O the issuing company? Because it's being sold here and B is acquiring it, right? Bail is acquiring the stock of O. So it's the acquiring, and by default, this will be the issuing. Now, the question is, right, then when we look at before and after, it's a, what do we go to, before and after? Guillermo? Guillermo, what was it before and after? Marlene? Before and after? Anna? Before and after? Not a trick question. Larry? And what? What are we looking at? What did he own before, percentage-wise? 60, right? 60 versus, what does he own after? Guys. He did own 40, but guys, you got to think out of the box there. I hate to phrase it this way. You will be sued. All right? That should wake you up. But you can't ignore the fact Claude still owns 80% of B. B owns 20 shares here. What code section applies? Attribution rules, right? So we have 40 plus 80% of 20 is how much? 16. Right? Now, everyone agree? Now, this is an example of 318A2C. Christy, you had raised this before with me, right? That 318A2C. If 50% or more of the stock in a corporation is owned directly or indirectly by such person, which in this case is Claude, such person shall be considered as owning the stock owned directly or indirectly by or for such corporation in the proportion of the value of the stock. So here, Claude is deemed to own 16%, or 16 shares, 80% of whatever Bale owns in this case. If you miss this, if you put 60 versus 40, you would have said exchange, right? It would have met the B2, 302B2, right? And you would have been, 100% wrong.
How did you get to 16?
80% of 20 shares is 16 shares. 16 shares is 16%. Company? Okay, you're lost? Well, you understand that Claude owns 60% before the transaction, right? He's now selling 20 of his shares. He now actually owns only 40 shares, right? But he owns a company that owns stock in another company. Under the attribution rules, stock owned by this company will be attributed upward towards him, right? He owns 80%, and when you look through, and that's what 318A2 talks about, is a look-through rule. We're going to look through and see what this company, if you own 50% or more of this company, and he owns that in proportion to his ownership, he owns 80% of a company that owns 20 shares in O. 80% of 20 is 16. So he actually owns 40 shares, but by attribution he owns another 16 shares. So he owns a total of 56 shares, because Code Section 318A5 says stock that you constructively own, you're deemed to actually own.
So it's going to be the 40,000 plus the 16,000.
Go slowly. Where did you get, what was the first thing you said? Irma. He owns 60 shares originally versus 40 shares plus 16 shares. 40 shares he actually owns and 16 by attribution. Irma, you're talking your own language. Say it again. You got it? After he sells it, he owns 40 in his own name, but he owns 16 by attribution.
What is the code section
For which proposition?
for that? The 80% of 20.
That's under 318A2 capital letter C. When you say he doesn't, this transaction doesn't qualify. So now we're in the thick of things because this will not qualify for exchange treatment. Everyone agree? This does not qualify for exchange treatment because when we look at the stock of the issuing company, before and after, we're not going to meet the B1, B2, or B3 tests. Agreed? Now, how much money is Claude sells his shares for $4,000? Claude would like to report a $1,000 capital gain. Everyone agree? Everyone look at this. Let's remember what Claude would like to do. Doesn't mean Claude gets what Claude wants, but Claude would like to report a $1,000 capital gain. Why? Code Section 1001, Code Section 1221 says capital asset. Claude would like to report $1,000 of capital gain and comes to you and probably says this is what he would like to report, can he, right? Can you picture a client? Many clients won't even ask you because they don't want to pay you, but they'll ask you after they're being audited and say, why is the government giving me a hard time? All right, putting that issue aside. That's what Claude wants. Remember, Claude just got a check for $4,000. Agreed? He got a check issued from Bail for $4,000. And we said 304 now is going to apply. Now, what does this mean? Because it doesn't qualify for exchange treatment, this instead is going to be treated as if Claude contributed this stock in a 351 transaction to Bail. Okay, everyone follow this. Irma, you with me? It's as if he took this stock, O stock, and contributed it in a 351 transaction. And now you guys are thinking 351, and your brains are going to code section 358 and 362. Agreed? If he contributes this to Bail, what are the consequences? Well, 304 says he's going to have a distribution, okay, Chapter 4, a non-liquidating distribution of $4,000 because he made this contribution, and he's going to have it, now we're going to apply code section 301C 1, 2, and 3. This company has no earnings and profits. Are we into the world of 301C2 or C3 or no? Because we have to look at the earnings and profits of this company, right? Right? That's where. What's my authority for that? If you look at 304.8, is it A2? I just want to make sure before I say that. Okay, B2. Okay, 304B2. The consequences to B is going to have $4,000 of ordinary income, right? $4,000, I should say dividend income.
Wait, isn't Claude?
Claude, did I say B? I apologize. B is Claude.
What is government do earnings and profit in our corporation?
It will go down. Okay?
So what would be the answer?
It will go down to 1. But JP, hold on 1 second and we'll get there. Okay. What's going to be Claude's basis in Claude's B stock? Okay, remember, there's a $500 per share overall $43,000 basis. What's going to be his basis as a result of making a de facto 351 contribution of the O stock? Okay, give me a total. What's going to be Claude's basis, adjusted basis in his B stock? It's not complicated. Don't overcomplicate it. Is equal to what? Started at 40. Thank you, Kevin. What do you say it is? Okay, 43,000, right? If you contribute property to a corporation, don't you normally just get a carryover basis? So his basis in his stock is going to go from 40, and it's going to go up by the $3,000 basis that he had in the contributed property, right? Right? We're just going to preserve. Okay, now, what else is going to happen? Out is going to, well, what's the adjusted basis? Bail will have, in this case, Bail's adjusted basis in the out stock. 3K, right? Because it's going to be under code section 362, right, Fatima? Not going to be fair market value. And then JP, what is going to be the effect on earnings and profits? Out E&P will go from 5 minus what? 4 equals 1. Right?
I was asking that if out doesn't have any earnings and profit, then how would the answer change?
If it has no earnings and profits, then what will end up happening is when Claude gets his $4,000, it would probably just be a return of his basis, okay? He would have a $4,000 return of basis, so his basis in his B stock would go from 40 down to 36, right? Because we apply first 301 C1, then C2, and then C3. Right. So the bottom line is, when you look at this, it's treated as if Claude, when we didn't hit, notice what happened. Let's summarize. Are you with me? We're going to just look at this and say, you know what? Before and after, did Claude's world change much? No, Claude is still, and excuse my cliches, still master of the universe with respect to both of these entities. Agreed? Claude calls the shots. And as such, when you get to call the shots, if you remember from our days of talking about chapter 5, does that feel like real redemption? No, it feels like a corporate distribution, right? Everyone agree that if before and after not much in your world has changed? That's the signature mark of a non-liquidating distribution. So Claude's world hasn't changed, and the code treats Claude as if Claude's world hasn't changed. And that's somewhat similar to these parents. When you take a look at the attribution rules, it's harder to see here, but these parents before and after, when you apply Code Section 318, their world didn't change much before and after, assuming their kids are proxies for them. So because Claude's world didn't change much, we go through our normal exercise of treating it as a non-liquidating distribution. Looking at this time, instead of one company's, 2 companies' earnings and profits, because Claude controls both, and treating as if we can't ignore the fact that, yes, now B owns some O shares, and we take care of that through this artificial 351 treatment. Michelle? Because remember, that was Claude's adjusted basis in the shares that he sold. He had a $3,000 basis in the shares that he sold. Okay?
So then, just to finish that, C's basis now obviously non-basis.
Yes, absolutely. I mean, if you want to take it that step, absolutely. And maybe, Michelle, that helps you. Michelle, yeah. Okay, and the overall basis would be reduced here, too. Well, I forget, if that was his basis per share, it was 150, which would remain the same, actually. Okay, so question A. Not the easiest, okay, admittedly, but you have a sense about you that before and after, things have not changed much. John? We're going to have that example. I think you were trying to, I didn't even pay you to do this. That's part B, okay? All right, thank you. Thank you. Claude sells all of his outstock to Baal for $12,000. All right? So, Claude sells all of his Baal stock. So we're going from 60 down to 0. So this becomes material. And now, Baal owns 60 shares. All right, everyone have that difference? All right, so keeping that in mind, I'll put you in the hot seat, Irma, see if you're following. You said you were, in your own language. But in your own language, can you tell us, and Alice and Sharon, see if you agree? We know a sale happened. We know, what is Claude's objective here? What would Claude like to report? Capital gain. And how much capital gain, guys? 3, right? Code section 1001, 12 minus 9, last I checked, is 3,000, right? You sell something for 12,000, your adjusted basis is 9, you'd like to report 3,000. Agreed? So, having said that, here's the question. Can he? And if so, why? And if not, why not? So, Irma, up, down? I'm going to ask you. Does this work? Does this qualify? Yes or no? There's always attribution under 318, but where does that get us? Alice, qualify or not? And Sharon, do you agree? And Alice, if you say so, why? So what did Claude, let's give our friend a name, our taxpayer has a name. What does Claude have before? All right, everyone agrees, 60, right? Everyone knew that. Now, Irma, what does Claude have after the dust settled? Killing me. Alice? Claude owns 80% of a company that has 60 shares. 80 times 60 is what? Irma, you didn't apply your attribution rules. You can't tell me 0. You can if you want to get it wrong, but I don't think you want to do that. Excuse me, you're whispering. Right. Through B, Claude is deemed to own 80% of 60 shares or 48 shares. All right? Now, do we meet the B2 or B3 test, guys? No. Everyone agree? We can't meet the B2 test. Okay? Why? Well, why can't we meet the B2 test, guys? Okay, remember under the B2 test, you must own less than 80% of what you owned before, right? We don't own less than 80%. We own 80%. Agreed? So we fail. I hate the word we fail. That's terrible. But Claude fails, not we. Claude fails the 80% test. Agreed? So we don't meet the B2 test. And Irma, for sure as heck, we don't meet the B3 test because there's no waiver here that we could ever exercise. Okay? There's no waiver of family attribution, and the entity attribution waiver of entity attribution doesn't apply in this context. Atik? Yeah, but 318 applies. So even though he sells all his stocks, he sells it to a related company, and through this related company, he still owns 48%. Ah, light bulb on? Okay, I thought it was a little dark in this room before. Not anymore. All right? So that works, right? Everyone agree? hold on. Now we have to apply, right, Wafa, the B1 test. And the B1 test, you can make an argument both ways. Okay? So, right, everyone agree that normally 60 versus 48? Are you master of the universe anymore? No. I mean, you may be master as to B, but you may not be to O. Everyone agree? Has Claude's world changed, at least based on the attribution rules under 318? And let's just go through this analysis. Okay, and I'll raise something in a moment, but let's just go with me on this. Wafa, you had that perplexed look. You with me, Wafa?
Yeah.
That yeah was not convincing. See? I missed my calling as a psychiatrist. No, go ahead. I'm sorry. Because the waiver only applies in a family attribution is the primary thrust of the waiver of family attribution, right? To have B3 apply, where you terminated your interest, under 302C, you can waive family attribution rules. But Claude, unless Claude's looking in the mirror, that's the only family he's looking at here. We're talking about waiver of entities, and that you can't waive, generally, right? You with me? All right. So we agree for the moment that B1 applies here, okay? So Claude is no longer master of the universe, at least as to O. Agreed? Went from 60 down to 48. And we want to know the tax consequences to Claude. Now life becomes a lot simpler, right? Claude has effectively sold shares to B. So what would Claude report in this context? And you got that from 12,000 minus 9,000 equals 3,000, right? Amount realized less adjusted basis, gain or loss 3,000. Agreed? Will Claude's basis in his B shares change? No. Will B now owns out stock? Everyone agree? Fatima, what basis will B have in its out shares? Not a trick question. Israel? Manta? Say it loudly. Where did you get that from? Remember, what did he buy the out stock for? For 12. That's a cost basis. If he bought it, when they say he, when B bought it for 12, it's a true exchange here. So B's basis, or Bale's basis, in its out stock is equal to 12K. Why wouldn't it be recognized? Sure as heck would be. Shade, why not? No. In this context, it's a true exchange. It was in the prior problem where it wasn't a true exchange that we treated as a 351. Yes, goes below the 50%. Yes, the 60 went down to 48. Right. Now, notice the contrast between A and B, guys. In A, Claude was or remained master of the universe as to the issuing company. Agreed? It didn't material change. In contrast, in B, it materially changed. Now, I only add an asterisk because and we saw that there were very different tax consequences, right, that came about, Shahid, depending if it were treated as a non-exchange in a distribution, then 351 was the effect to B and O, but Claude still had a $4,000 distribution, so it wasn't tax-free. So don't think of, 351 is going to be tax-free. It was just used for purposes of determining the basis that Bale had and that Claude will now have in his Bale stock and Bale would have in its O stock.
So this event was that if there was, like, we didn't fall below 50%, then the 3K would not be, would be considered,
Well,
so in other words, if it was a 351 transaction, then 3K would not have been there.
I mean, but remember, it's not like Claude would have income under 301c1 of $4,000.
Forget that.
I don't know if I can forget that because
I think you're referring to part A, I'm referring to part B, that's what I'm saying.
Part B is a whole different ball of wax. It's treated as an exchange.
And recently, because it has fallen to 4%.
That I don't know if I want to say it, but it qualifies, or we think it qualifies under 302b1. That's the better way to say it because we're looking at 302b1, 2, and 3, right, Matt? You had a question.
Yeah, so I just want to ask a real quick question. So I think I'm smart. C's basis in B now after the sale.
Right.
Is it changed before? They also
C's basis in B
B
stays the same.
Stays the same.
Stays the same. No change.
Because it was a sale.
Yeah, it was a sale. It had nothing to do with his investment in B.
What about the questions?
So there is no
In question,
here on the year.
look at, with respect to earnings and profits, guys, look at, let me see if I can call your attention to, on page 277, the second full paragraph. If I could answer this question and say, I know the answer, you should tape record me and then tell the authors that I really know the answer because apparently they don't and no one's ever questioned them for all the people who looked at it. So it's not clear what the effects are in this context on earnings and profits, okay? So I wish I had the answer, but I don't. Read this paragraph, you'll see it's kind of a mystery. If earnings and profits should even be changed. All right, so again, not holding back, but all right. So for exam purposes, now people's here, look, this is not easy stuff, but on the other hand, question A and B are just to give you a quick illustration of the different effect between where there's a meaningful change and where there isn't, okay? Question C and D aren't, I even crossed off question D. Question C just says, same as A, except that Claude receives $3,000 and 1 share of Bale stock, fair market value of $1,000 for his 20 out shares. Let's go slowly. It says, same as A, except that Claude receives $3,000 and 1 share of Bale, fair market value of $1,000 for his 20. So he's going to try to treat it as a 351 exchange where he's getting back $3,000 a boot. Okay? So let's just pause and say, hey, does this work? If Claude was to try to do the same sort of transaction where he contributed stock, contributed his O stock and got back Bale stock. Okay? He's in control, right? He meets the control test. Can you have a 351 in this context? Can someone contribute, if you're Claude, 368C applies, right? He controls 80%. Everyone agree? Can he contribute his O stock, B? Let's go back down memory lane. Contributes his O stock. And normally, when you contribute property to a corporation in the 351, you get back stock, and that's tax-free, right, Shahid? You contribute property, and you get back stock. Everyone knows, because we all see the bright red carpet treatment here. Congress welcomes that. Everyone agree? But now we're not only getting stock, we're also getting property. And what do we call that property at the cocktail party? Boot. We're getting boot. Okay, so we got boot. how much, Shahid, income would you have to recognize, just assuming 351 applied here? Well, just tell me, and then Mahbub, see if you agree. How much would you say the taxpayer, if this is a 351, would the taxpayer have to recognize here? Would you agree, Mahbub? I'm sorry? Mahbub. How much is realized gain here? See, that's a trap, right, Shahid? What is the realized gain here? How much? It's 1,000, right, Shahid? Can you ever recognize more than you realized? So here, the taxpayer, Claude, is being kind of cagey because he's trying to contribute property under the 351, get back boot, but his gain would be limited to the amount realized. Everyone agree? His amount realized here is limited to $1,000. So does our cagey Claude, does this work? And the author's point in calling this to your attention is Code Section 304B3A. It says coordination with Code Section 351, except as otherwise provided in this paragraph, subsection A, and not 351, shall apply to any property received in the distribution described in subsection A. What the author's point here is calling to your attention is that here 304 trumps 351, right? 304 trumps. So notwithstanding what Claude is trying to do here, Claude is unsuccessful. Claude would have a $4,000 dividend here. All right? So notice the difference. 351, if Claude is cagey and tries to fit this in the scope of 351, 351 takes a back seat to 304. Because right here, that code section I just referred you to, code section 304B3, capital letter A, essentially says, that 304 trumps code section 351. It's one of the few times that 351 takes the back seat, but Congress is not that concerned in these contexts because here the taxpayer is apparently playing a game, trying to avoid code section 304. Michelle, you had a question? Well, no. If 351 applied, if you got boot, the amount of income you have to recognize in a 351 is limited to the amount realized. Here, the amount realized to Claude would only be $1,000.
Yeah, how does it be just like how justice
Oh, say it again, Tina?
if you are mathematical minded, I still think
What's your question? Well, what is Claude on his outstock? Shahid, what is the amount realized and what's the adjusted basis here? Yeah. Question C. Or Jared, you were saying before. Okay. Do you see that his adjusted basis here is 3,000? How did you get 3,000, Jared? That's if you take the number of shares he's contributed. That's his basis in his 20 shares. 20 times 150 is 3,000. Getting 4,000, the amount realized here is going to be 1,000. I'm not going to worry about question D. Question 3 is trying to raise the question or bring to light that because dividends are taxed at the same rate now as capital gains, is Code Section 304 as necessary as it once was? Who knows? It's hard to say. It's certainly not as necessary. Congress obviously has had the last 10 years to repeal Code Section 304, but it still lurks out there. All right, so we're not going to decide that. Question A and B, just very simply, look make sure your eyes focus on the issuing company. Look at it before and after. If the interest in the issuing company has gone down significantly, Code Section 304 will treat it simply as an exchange. If it has not gone down significantly, then you have a whole bunch of rippling effects, okay? Go ahead, Ally.
The 304 50% control rule, that's looking at before and after, correct?
Yes.
Okay, so that's would fall below 50.
Don't use the word below 50.
I understand what that 50%
I'm not even saying before. I'm saying before and after. Look at it before and look after at the issuing company, and then look at B1, 302, B1, B2, and B3. Who had said, I didn't say.
Well, in section 304, it says something about 50% control. I'm trying to.
That's for control to see if Code Section 304 even applies.
Yes.
Once you apply it, then you look at the issuing company and apply before and after to see if B1, B2, or B3 applies under 302.
Yeah, understood. So what I was trying to determine is that 50% rule, initially, we look at the shareholder and see if they hold 50% of each of the companies in
Right.
the weighted, correct?
Yes.
Okay, so that's, I just wasn't sure what that weighted.
Okay, we're good? All right. Now, speaking of things on page 287 that who knows if they're relevant anymore, redemptions to pay death taxes, or I would rather the author say pay estate taxes, because it seems to me to have a political twist on this if we say death taxes. I will give you the 1-minute version of the U.S. estate tax. If you were to look at chapters 11, 12, 13, and 14 of the Internal Revenue Code, beginning at Code Section 2001, you're not going to be tested on this, but I just wanted to make sure you understood it. The U.S. government still imposes an estate tax on people whose estate exceeds what threshold in the year 2013? Not 5 million. 5,250,000. Okay? And if you exceed that threshold, Scott, what's the tax rate?
I don't know, a lot.
Anyone want to venture? What's the estate tax rate? Say again, Sharon? 35? Old Lloyd? 39.6? Well, should I give it to Christy? It's 40%. It was close enough. Okay? 40%. Okay, if you cross that threshold. And the exemption amount is now portable between spouses. So your spouse dies, you can now get your spouse's exemption without where in years past you had to establish so-called bypass trust. So now your spouse dies, you can transfer $10,500,000 tax-free. So the estate tax now affects what percentage of the U.S. population? A 0.1%, a whopping 0.1%. So having said that, when you hear about, now I hope you don't find this too political, but when you hear politicians on the steps of Congress saying this estate tax is ruining small business, depends on, I guess, your version of small business, okay? But there's a portrait painted that the average Joe six-pack is losing his or her family farm, but take that, I think, with a grain of salt. But there is an estate tax. It does. New Jersey has its own estate tax, right? Because you file New Jersey when you file your own 1040 in New Jersey, and then federal, and then you file New Jersey 1040. What is the New Jersey threshold? New Jersey is one of 17 states that still have an estate tax. What's the threshold? 600 used to be. What is it now? 675, right? 675. And if you exceed that threshold, it's a graduated tax rate. It's essentially 10%, but it goes up as high as 16%. So many people in New Jersey, what do? They die in Florida. I mean, they move to Florida. They change their domicile. You can't, on your deathbed, say, wheel me out of state and bury me in Florida. That won't cut it. You have to change your domicile. All right, that doesn't, so some pre-planning. All right, so keep in mind that taxpayers might not be that anxious to go through the whole rigmarole of terminating their interest and all the things, waiver of attribution rules. And Congress, we know Congress has won what we call friendly hand of death, and that's memorialized in Code Section 1014, right? 1014 is a very tax-friendly provision because it makes basis equal to fair market value. So if you're very wealthy, it really eradicates a lot of that taxable gain. Code Section 303 is one of those tax-friendly provisions that says that if you're going to have stock redeemed to pay estate tax, that will automatically qualify as, and you don't have to worry about meeting all the family attribution waivers or anything like that. So it's a tax-friendly provision, if you can call friendly a death, friendly, I don't know, that may sound like an oxymoron. So long story short, this is not offered to all taxpayers. Your closely held businesses have to be significant relative to the size of your estate. It has to exceed 35% of your gross estate, okay? So if your stock exceeds 35%, and you have to own 20% or more of that particular company. Let me rephrase that. You have to, your closely held businesses have to exceed 35% of the total estate, and if you own multiple businesses, you have to own at least 20% or more in each of those businesses in order to get this special treatment. So let's take a look. I mean, this is one of the least important code sections because it applies to so few taxpayers. But on page 289, a very quick example because I want to make sure we have enough time to cover Chapter 6. George unfortunately died last year, had a gross estate of $6 million. He expects to incur $300,000 of death taxes and allowable deductions for expenses and losses under Code Section 2053 and 2054. George's gross estate includes stock in X Corporation with a fair market value of $600,000 and Y Corporation fair market value of $1.2 million. The fair market value of all the outstanding stock of X and Y is $4,200,000 and $4.8 million. So, and his wife Adele also owns X stock. She owns $600,000 of X stock, and so together they own $1.2 million of X stock as tenants in common. If Y redeems shares from George's estate, will the redemption qualify for exchange treatment under Code Section 303? So we just have to see, first of all, does he own 20% or more in each of these companies, X and Y? What's the denominator of X? 4.2 million. What's the denominator of Y? And what's the numerator? 600. Hold on. Is it? You got to include the wife. Why? Because there's a code section 303B2B. Just take a look at 303B2B. If you see that, if it says special rule for stock held in two or more corporations, for the 20% requirement, the second sentence under there says that you're deemed to own your spouse's shares, right? So with respect to X is deemed to own what? 1.2 million. And Y owns 1.2. So the percentage is what? Isn't 125%? and the other one is 28.57, but who's counting? Okay? So both of these entities exceed our shareholders. As long as they exceed 20%, they're okay. As long as they exceed 20%. So both of these companies qualify towards the 35% test. There's two different tests. You own 20% or more in a business, and if so, multiple companies can be included. But now we have to see if we cross the 35% threshold. In other words, we have, in order to qualify for this special treatment, we have to look at 35% of the gross estate less expenses. What is 35% of the gross estate less expenses? It's 5.7 million, right? It's $6 million less $300,000 of anticipated deduction in expenses. So we have 35% times 5.7 million is equal to how much? $1,995,000. So George, that's our just seen in here. George has a total estate of $6 million. After expenses, $5.7 million. In order to get this special treatment under Code Section 303, his estate, the closely held business interests, have to exceed 35% of $5.7 million. This is meant for the Donald Trumps and the people who have multiple small businesses or one large small business that comprise a very significant portion of their estate. Agreed? Does George get to the promised land of $1,995,000? Now you might say, gee, George is in luck. Why? Because if you look at the value of his closely held businesses, at least here, they total what? $2.4 million. However, remember that for this 20% rule, we could use the shares of his wife. Everyone agree? Adele. Adele's shares were included. Why were they included? We were told to include them under 303B2B. Okay, we got to include Adele's shares. But when we apply the 35% test, we're not allowed to use Adele's shares. So what is the total estate, the value of George's shares? $1,200,000 plus $600,000 equals $1,800,000. Guess what? George is out of luck for two reasons. He's dead, and it doesn't qualify under 303. All right? The point is, again, there's two different tests operative here. One is a 20% test to see if those shares can be included for computation purposes, and those shares use the wife, the shares of a spouse. The 35% test does not. It does not. It only are those shares includable, or the value of those shares includable in your estate. I don't want to spend a lot of time on this because if 0.1% of the country's estates are subject to estate tax, 0.0001 will have a 303 redemption, okay? Because many people who are elderly and who die, by the time they die, have divested themselves of stock, so it doesn't come up all too often. It would not qualify. And therefore, right, Christina, you'd have to go through your 302B3 perhaps and try to get waiver entity rules and things like that. Chapter 6. Stock dividends. Right? Now, we turn our attention, in this case, Code Section 305, and it talks in general, except is provided in this section, gross income does not include any amounts distributed on the stock of a corporation made by such corporation to its shareholders. Now, Allie, do you have your stock certificate? I didn't think you would. Oh. Okay, so now you do. Okay, now you do. Now, if Allie, you have that stock certificate of 100 shares, and the company declares a dividend, and it's going to give you another piece of paper. If it does, do you feel any richer, Allie? Do you have to pay any tax? No? Priscilla, should she pay tax? She now has 2 pieces of paper. I don't speak with authority. Who does? So you have no gross income, right?
Yeah, my base is.
It does? And what's your authority for that?
No, base doesn't increase, but I guess the overall base stays the same, but my basis in each stock will decrease because I have more now. So,
Okay, and what's your authority for that?
I don't know, but I.
Angie, does she have authority? Ehor? 307, who said it? John? Yeah. Truly, and in my book I have it too, Code Section 305A and Code Section 307 are married at the hip, right? So when Allie gets that share, she doesn't feel any richer, and she doesn't have gross income under 305A. And under Code Section 307, her basis does not go up, but she has to allocate her basis by how? John, how is she going to allocate her basis?
She would take the basis of the whole stock, multiply it by the number of shares.
She going to allocate it based on the number of shares between the old and the new? Adele, do you agree? Is that how you're going to allocate basis? Right. She now needs to know, she has 2 pieces of paper, she needs to know her basis in each piece of paper, right? Is that how 307 operates, by the number of shares? Because that would be subject to a lot of manipulation, right? All right.
Isn't by weighted average?
What kind of weighted average? Fair market value, right? That you can't play games with. If you allocate it based on fair market value, you'll look at the old and the new, and you'll divvy up basis based on the fair market value of each, right? That's what Code Section 307 mandates. Allocation based on fair market value. All right. So 305A and 307 go together insofar as that's concerned. But keep in mind, 305A says generally not taxable, but what we'll learn is there room for taxability here? Yes. Under what code section? 305B is replete with exceptions. Okay, so 305A suggests, at least initially, that the receipt of stock is not taxable. However, 305B has numerous exceptions, which in many respects overwhelm at least the starting rule of not taxability. If you look at Code Section 305B, entitled Exceptions, and that's what this whole first part of the chapter is concerned with, there's multiple exceptions that are spelled out in 305B, which, just like 302, B, you have to have a good handle on. These you do as well. 305B1 talks about distributions in lieu of money. Now, some of you may recall when I spoke about it, and some of you have tax accounting right now, when you have a choice between stock or money. Well, if you have a choice, that's constructive receipt, right? Because if you can get cash, and in lieu of taking cash, you take stock, it's almost as if you took the cash and purchased the stock. So that's not going to get you very far. And when you look at Chapter 6, what the authors do is they talked about historically what was the situation. And there was an old test. And the old test was what was referred to as the proportionate interest test. And normally, when Ellie has one piece of paper, now two, has her interest meaningfully changed in that corporate entity? And the answer is, chorus is supposed to say no. I'll be the chorus. No. Okay? You guys are all supposed to say no. Allie has two pieces of paper, and truly Allie does not feel any different before and after as a result with her relationship. Everyone has interpersonal relationships. Did you ever think about your relationship, Allie, to a corporation? And don't want to go there. But you will today. Your relationship to that corporation has not changed, right? As a result of having two pieces of paper. And it shouldn't. It doesn't, nothing has changed. And why do corporations then do, many corporations will do so-called stock splits. If it's kind of a meaningless act, why go through that exercise, guys? What's the agenda? What's the corporate agenda? Why do corporations do that? To reduce the price. And so what? In other words, stock prices should go from $100 down to $50. Why? Attract more people. I mean, it's really kind of illusory, but it does give a perception of, instead of the person who could only buy 10 shares can now buy 20, they feel like they are owning a bigger piece, and it's psychologically the market. Somehow you can't do this every day, but strategically it's sort of a power play. Like, gee, we're becoming so valuable, we'll do this, and it makes shareholders feel good. They have more paper and things along those lines. But the reality is, Allie shouldn't really feel any richer. So that was called the proportionate interest test. However, and that test was kind of like substantially equivalent to a dividend. It was not always easy to measure. But sometimes, like for example, in B1 it talks about distributions in lieu of money. If Allie and Angie were 50-50 shareholders and there was an opportunity for taking cash or stock, and Allie took cash and Angie took stock, all of a sudden Angie's world and Allie's world have both changed, because Angie's now master of the universe, at least vis-a-vis that corporation, and Allie's not. So in the morning after, it's a vastly different world out there. And if you feel like the world is vastly different, meaning with respect to your relationship to the corporation, then Code Section 305A doesn't probably apply. Okay? And it likely will be a taxable event, this receipt of this stock certificate. Okay? And that brings us to what world? If you get 301, right? So I know some of you would consider skipping or forgetting Chapter 4. There is no skipping or forgetting Chapter 4. Right? 305B2 talks about disproportionate distributions. Some shareholders get, many of these are just offshoots of, they all have similar overtones or undertones. The receipt of property by some shareholders and an increase in proportionate interest by others. Distributions of common and preferred, where some people get common and some people get preferred. Again, your relationship with that corporation has changed with respect to the other shareholders. Distributions on preferred stock. Distributions on preferred stock. Always considered to be taxable. And then distributions in convertible preferred stock may or may not, depending on the Treasury regulations, and we'll see examples of this, that depending on the conversion feature, where some people convert and some people don't, right? Get the visual on that. Some people convert, some people don't, may result in some people getting the equivalent of receipt of property by some shareholders and the other shareholders increasing their proportionate interest. 305C talks about certain transactions treated as distribution. So even if it doesn't jump off the page, like this doesn't jump off the page as being a 304, certain transactions in particular, periodic redemptions. Periodic redemptions can result, even though it doesn't say stock distribution, periodic redemptions can get you to the same place where some people get cash and some people get additional stock interest. Okay, let me repeat that. If we have a series of redemptions, and that's illustrated on page 299, Revenue Ruling 78-60. This was not a one-time redemption. It was periodic redemptions. If you have periodic redemptions with the result that some shareholders are going to be treated as if they had a 301 distribution, meaning that they had the equivalent of in most instances, a dividend, and the shareholders whose shares were not redeemed are going to have a larger proportion of the company. Guess what? The shareholders who didn't get the cash, who didn't get the distribution, and they just sat there with their stock, and they held on to it, are going to be deemed to have increased their proportionate interest. On page 302, it says, the conclusion, the first full paragraph, B, X, and the 16 shareholders of Z who did not participate in the redemptions are deemed to have received stock distributions to which Code Section 305B2. B2 talks about disproportionate distributions. And Section 301 of the Code applies, and there are certain examples in the regulations. And this is a good way for me to segue into a good warning to you. And when I say good warning, a heads up. The authors ask you to read certain examples. I'll just call this to your attention. On page 292, the authors cite you to these regulations at the bottom of page 292 under taxation of stock dividends under Code Section 305. The authors call you to several different examples in the regulations. There's never a good reason to skip reading the regulations, but here, truly you do it to your own detriment. Why do I say that? If you read the regulations and the examples promulgated thereunder, that the authors of this textbook, for those who have any supplementary text and on your exam, it's very hard to vary from those examples and be creative here. So my hint to you, and a strong one at that, is if you read the examples in the regulations, the best anyone can do, and you'll see that in the examples here, is paraphrase them and come up and ask you questions. In other words, you can't be too creative here. So if you read the examples in the regulations and you understand them, and you understand the problems the authors give you, which are just a rehashing of the regulations, I can't be that creative on your exam, so you'll see just some, one more variation on the examples under 305. So just, what more can I say? So my message to you is read the regulations, read the examples, because they will serve you well. Now on page 302, they talk about what they call the collateral tax effects. So remember, Code Section 305 is an identification section. It's not a taxing provision. And what ends up happening here, remember, generally anytime you get something, it's taxable unless the code says it's not. And 305 says it's not if you don't fall within the scope of Code Section 305B. If you do, however, then you're within the scope of 301. Any distribution from a corporation is generally taxable under 301. And 305A does not apply. So the first paragraph under the note, I have a line around it saying, okay, this is the effect. I have in my margins 305B, that first paragraph. The second paragraph, I have 305A. What are the effects of 305A apply? And just to remind myself, you know, that when you have 305, you always have 307, right, Sean? Always the 305 and 307, and just, you know, again, I don't have to do this, you don't have to do that, but on the top of my Code Section 305, I write 307, just, you know, remind me that, you know, these things go together. To keep you at the edge of your chair, why don't we hold off doing any of the problems and take our 8-minute, 9-minute break and pick up right here, okay, guys?